Okay, I'll just check that you guys can hear all right. So if you just quiet down, we'll get going. Can you guys hear all right over here? Does this sound okay? Sound okay? Sound okay over there? It's okay? Good. And you guys at the back, you okay for sound? I just think that's a nod. You guys okay for sound? You good? You good? Okay, and you guys in the middle? Yep. Okay, so if you just quieten down, we'll make a start. Okay, so next week on Thursday evening is the test, and so the style of the questions and the number of questions is basically the same as last year and the year before. So there'll be 6 questions on the topics up to and including the last one. And so basically this point here, when we're starting the markets, this part will not be in that test. So it's basically covering up to that point there. The test will be an hour and a half long, 6 questions. Most of them are descriptive, so you write. There are, as always, a few numerical things in there. Now, one thing you can take in with you, well, several things you can take in with you. You don't have to have those, silver stickers on, that UC stickers on the back of your calculator that is sometimes required for other courses. You can basically take any calculator you want. And of course, as many calculators as you want as well. And the other thing you're allowed is what we call a formula sheet. This can be up to A4 in size. You can use both sides of the paper. It can be handwritten or printed, but it should primarily contain formulas. So you have a formula, you can have a title of the formula, and you can have an explanation of what each of those variables is. And within the sort of heading of formulas, I also include things like, if you have a financial calculator, but you want to write down a specific set of keystrokes you need to solve a certain type of problem, you can include that on your sheets as well. So that you can take in with you, and it does get collected in as part of that test. So are there any questions on that before we go into the topic for today? Everybody's happy. Okay, so today we start the first of the 5 topics on financial markets. So this is basically like the middle third of the course. And so today we're going to start on the money markets. And when we talk about the money markets, there's probably several links with past topics. One is just in the previous topic we talked about market segmentation and the preferred habitat theories. When we talk about the money markets, what they are, their purposes, and so on, that'll hopefully link back to that topic. And the other thing that we're going to link back to is when we talk about the cash rate, the cash market, and the repos. We've met them before in the section on the Reserve Bank, but we'll meet them again here because they are part of the money markets. So this is an outline of what we're going to do. We'll talk about the economic role of the money markets, and they are definitely markets, not a single market, the characteristics of those markets, and then the instruments that are used within them. And then we'll look at a few of the markets, the interbank cash market, which we've actually met before, the repurchase agreement, again, we met those before. Then New Zealand and Australia Treasury bills and notes, those are government securities, and a bunch of private sector securities, commercial paper, negotiable certificates of deposits, asset-backed commercial papers, bank accepted bills, and then finally, who actually are the people who participate in these money markets. So when we talk about money markets, the term's actually used in 2 ways. One in this sort of technical sense, we're using it here, about a specific set of markets, but often, like if you listen to a financial markets report, they'll often call that a money markets report, but it's used in a rather colloquial sense here. So we have a very specific sense that we're talking about in money markets here. Now, there are a group of markets. There's actually several of these markets, and each particular market has a very specific instrument that it trades in it. So if you're going to deal with bank bills, there is a specific market that deals with bank bills, which is separate from the commercial paper market, but both of those are money market securities. So they are separate markets for each of the securities that is traded. They are over-the-counter or dealer markets. Remember, we talked about those right back in the beginning. So if you trade in this market, you either buy from a dealer or you sell directly to a dealer, and There isn't anything like an exchange or any central location for the markets. You simply deal directly with the person who's usually working on behalf of, say, something like a bank, who owns the securities. Either they sell them to you, or if you're selling to them, they buy them and put them in their inventory. There are also wholesale markets, so this is why most private individuals are not involved. Usually you'll find these markets a minimum size of $1 million, and often you'll find that the minimum sizes are significantly larger than $1 million. That's just the absolute bare minimum to trade there. Typically the actual trade sizes are significantly bigger than that. So it's not a market that the small investor is investing in, but certainly very important markets for the functioning of the financial system. So we'll look at the economic role of the money markets. So anyone read your book enough to know what the economic purpose of the money markets is? Why do we actually have these things? And they're definitely separate from the bond market. They're definitely separate from the equities. They're separate from derivatives and all that. Why do we have a separate group of markets for the money markets? What are they there to do in terms of making our economy run smoothly? Just liquidity. What do you mean by that?
Just like maybe if there's tons of bills they need to pay, something like cash, they need cash and they'll get reimbursed.
Okay, so the basic reason for the existence of these markets is to adjust liquidity. And so there's, when you look at the way businesses work, they often don't have even cash flows in and even cash flows out. Usually they're quite lumpy. There'll be a whole lot of cash flows out at one point, and then at some other point there'll be a whole lot of cash flow in. And so these markets exist to smooth over that particular problem. So if you're a company and you're profitable, but temporarily you're short of cash because you have to make some payments, then the place that you would probably go to is some sort of money market. Similarly, if you have excess cash on your books that you don't need right now, but you know you'll need it very soon, and you just want to invest that for a short period of time, then you would probably invest it in the money markets. And when you think about how businesses work, I mean that's common to all sorts of business. Can be as extreme as, say, take an example of a grape grower. They might be paid once a year. So they have huge cash flow in, and all their other periods of time there's cash flow out. But pretty much that's a common characteristic of most business. Cash flows in and out, although overall they're profitable, they don't match each other nicely, and so there's times when they have excess, time when they have insufficient, and the money market's there to deal with this problem of these lumpy cash flows. So, a couple other things in it. What does this mean? It says liquidity status of commercial banks is reflected in their buying and selling on the money market. What do we mean by that? When we're talking about commercial banks and their liquidity status, what do we mean? Oh, everybody's very quiet. Yes, go ahead.
So basically looking at how the demand for money market securities will usually show us if they need more liquidity. And so basically if one of the commercial banks is short on liquidity, then they'll go and they'll sell their money market securities in order to get more liquidity. So yeah, that would be how their transactions reflect their liquidity status.
Yeah, okay, so that's what it's doing. So most of you probably didn't hear that, so I'll summarize. So basically, if a bank is short on liquidity, it needs more liquidity. I mean, it issues money market securities. If it has excess, of course, it's a net buyer rather than an issuer. Now, this is one of the things, like when you think about what on earth do those reserve banks do when they have these two-day meetings, when they're thinking about what they're going to do with the cash rate. Or in New Zealand, it's only one-day meeting, but they have one-day meeting. This is one of the things they look at, is what are the commercial banks doing in these markets? Because when you think about why would they actually need more cash? Well, one of the reasons they need more cash is that they have a strong loan demand. So one of the things that the central banks look at is, are they net issuers of money market securities or are they net buyers? If they're net issuers, that tells the central bank that there's a strong demand for loans which they cannot meet by increases in deposits. So they have to go out into the money markets. Conversely, if they see the other thing, that they're net buyers and they're sort of letting liquidity run away, then that tells the central banks that demand for loans is not particularly strong. And so, although it's simply from their point of view, it's a liquidity adjustment point of view, they're just changing their liquidity as required by their business conditions. For a central bank, it gives them an insight into what's going on in the economy. The thing we talked about before is that it's a place where the reserve banks undertake the open market operations. And, you know, we've dealt with that as to why they trade there. So this is the basic idea. If your inflow is less than your outflow, okay, you're going to have a temporary shortage of cash if you're a business. Okay, you have to be profitable, but sometimes you get in these temporary situations. If you're temporarily short, you borrow, and ultimately you will pay interest back across to whoever loaned you the money. If you're on the other side, if your inflow is greater than your outflow, then again, you may well have a temporary surplus of cash, and because you don't need it right away, you probably go and invest it across there and earn a bit of interest on it, come back to you. So it's primarily for shifting of liquidity in and out around businesses. It's not about long-term capital development or anything like that, simply management of liquidity. Any questions on that before we move to the next one? Yeah, go ahead.
Just wondering that the repo we talking about before with the money market.
Yeah, a repo is a money market instrument. Or in one sense, it's quite odd in that it always depends on there being another security that is traded. But the repo market itself is considered to be a money market in itself, even though it deals with the security as part of that repo. So it's definitely part of the money markets. Okay, any other questions? Okay. So that leads us to ask, well, if that's the purpose, what type of instruments, securities, do we need in this type of market? So what are the key characteristics that we need? If we're going to have these instruments, and we know that the economic purpose is just for liquidity adjustment, either we want to bring in liquidity temporarily or invest it temporarily, that gives them some requirements for the instruments themselves. What sort of things would you be looking for if you only want to do a very short-term investment? Yeah, go ahead.
So it's like its characteristic is less than 12 months maturity. You have to have short maturity.
Okay, so one of them is it has short maturity. Now, that gives us some advantage in terms of interest rate risk. Okay, remember we talked about interest rate risk. Longer the time to maturity, the more interest rate risk we have. So by having a short time to maturity, we have very small interest rate risk. So that helps, having short time to maturity helps us to eliminate interest rate risk. Any other characteristics of these instruments that are important to us? Yeah, go ahead. Okay, low default risk, because this is money that you're going to need. You just don't need it right now. And the last thing you want is default. So in one sense, when you're thinking about investment, this is not money that's going out looking for a high return. It's just a little bit of interest, short period of time, and so you want low default risk on these instruments. Anything else about them? Yeah?
I think, on the other hand, I think it's going to be the large reinvestment risk.
Large reinvestment risk?
Yeah.
How do you figure there's going to be large reinvestment risk?
Consider that because it's a shorter term, so you're going to get a large amount of cash flow. Because the interest rate drops significantly.
Okay, so the reinvestment risk is actually, when you think about that, we actually think of the reinvestment risk as actually residing within a single security. So if you think of that bond, we talked about bonds, and they pay those coupons, the reinvestment risk arises because we have to take those coupons and do something with them. Okay, in the money market, they actually don't pay coupons, and so the fact that they don't pay coupons means that these type of instruments don't have a reinvestment risk. Okay, Because I understand what you're talking about, because you're saying, well, they run out very quickly, and then you have to go and reinvest. But that means that you actually go and reinvest in a new security. Now, reinvestment risk, as a risk as we talked about, is within a security, like a bond. Okay. I mean, you're quite right that once it rolls over, you have to take a new interest rate. But that risk is not within that instrument. It's across time as you change. Okay. So there is a point there. They don't pay coupons, and because they don't pay coupons, they don't have a reinvestment risk. So got rid of risk there as well. Anything else you need about these things? Okay, go ahead. Okay, so high liquidity, high marketability, and the thing is with these things, if you go and invest for a short period of time, sometimes if you're a company, you may be called upon, that cash may be needed sooner than you expected, and you want to be able to get out of these things really quickly if you need to. So you need high liquidity both for getting in at any point that you want to, and high liquidity for getting out as you need to. So we're thinking about liquidity risk, low liquidity risk. So I think that's most of the things. Not sure if I missed one here. Oh, we probably missed this last one here, which is the large denominations, and that's to reduce the transaction cost. So when we're thinking about the characteristics of these things, low default risk, short time to maturity, which reduces the price risk, no reinvestment risk because they don't pay coupons, high marketability so you can get in and out as needed, and they trade in large denominations to reduce transaction costs. Basically what we're looking for in this market is things with as low as amount of risk as possible. Okay? So all of those characteristics are there about having low risk in all aspects of these particular securities. Now, they are traded. This is actually turnover. So this is Australian, so this is getting a bit old. So this actually, when you think about at the time that this chart was put together, the actual Australian economy was about 1.7. Sorry, that's trillion dollars economy per year. And when you see the amount of trading, like say in this one here in the bank bills, this is over $3 trillion worth of bank bills traded each year. So that's like twice the size of the actual Australian economy. Here the repos down here, $3 trillion in government bonds and another almost $3 trillion in state government bonds. There's an enormous amount of trading going on in these markets. Lots of trading going on here. So when we're looking for liquidity, they are the most liquid markets there are. Now, in this respect, the U.S. market's actually had some problems in recent times. Here's some fresh data. Now, unfortunately, this thing doesn't have a scale on this axis here to tell you what that actually is. But here's 2003, and there's 2015. And this is the U.S. Treasury market. So this is for the short-term U.S. Treasury securities. And what's happened there is that the trading has dropped off. In fact, it's dropped off by about 70% from the peak in about 2006, 2007. And the amount of trading going on there has dropped down. And this fact, the reason that this article was written was because of the drop-off in liquidity. And when you think about what we want in these markets, we want high liquidity to get in and out at any time. The U.S. Treasury market has become far less liquid over the last sort of 10 years or so. And what's happened in that market is that they've seen the emergence of the buy and hold investor that they never saw before. So people would buy these things, but they would very rarely hold them to maturity because they were buying them for liquidity purposes. And so many foreign governments, foreign investors as well, have been buying and holding. They don't trade them. And also the other thing that we've seen in this period of time is that the central bank itself has bought vast numbers of them, and they've bought them and held them and not traded them. So the fact that the liquidity has gone down in this market means that we have a bigger liquidity risk. Now, somewhere in here in the article, probably not in the bit I photocopied, they say that reduction in liquidity has put about another 15 basis points on the yields because of the additional liquidity risk that's arisen from the fact that there's been this drop-off in turnover. So when we talk about liquidity risk, 15 basis points doesn't sound like much, but that's what the market perceives as the risk that has occurred with the drop-off in the trading. So I think we said most of that. This one here, quite interesting. You can trade for $3, and you can have an arbitrarily large trade for $3 in fees. So you can trade 100 million or 500 million for $3. So when we're talking about high liquidity, low transaction costs, $3 per trade, when you're doing millions of dollars in a single trade, the transaction costs here are pretty low, and that's what we need. Because we don't, when you're thinking about if you're only investing for a day or two with a low interest rate, you don't want your little bit of interest that you're earning being sucked up in transaction fees. And so they can be traded very easily and very quickly at low cost. Okay, any question on that before we move to the first of these actual markets? Okay. So, this should be a review. So what's the cash market? When we talk about the cash market, what are we talking about? Have met this one before. We have met this one before. Do you remember what it is? No. No. Do you remember what it is? No. Okay, there's a test next week. There's a test next week. You better learn this stuff. Okay, anybody else know what yeah, go ahead. Yeah, it's the trading in the ESA accounts. This is where the banks trade amongst themselves, and also the central bank trades in this market as well. So that's what the market is. Why is it so important? Why is it important? This is it's tiny. It's actually tiny, but very important. Why is this one a key market as far as the economy goes? Yeah, go ahead.
Just you spoke before, I think it's easier for the Reserve Bank manage the interest rate, manipulate the demand, the supply, so that strictly influence the whole market.
Yeah. So the key point about this market is that the Reserve Bank trades in here, and the idea is if by trading in this market, and this is the only market they trade in, that if they push the interest rate up or down by changing the supply, that change will feed into the wider market. And so this is, when you're thinking about central banks, how they manage economies, this is the place where it all starts, in this one. So this is a key market for the economy, and central banks are involved in here. So it says these exchange settlement accounts, and so these are the ones where the banks settle between themselves. And one of the requirements, if you remember back, is that the banks always have to have a positive balance in here. You can't run an overdraft in here. So if you start to run low, then as a bank, you'll need to get more money to put in there, and that involves trading in that market. Now, one of the things about this is I don't think anywhere I haven't got how much trading goes. It doesn't actually say anywhere in the book about how much trading goes on in this market. But typically, in this market, a dollar in this market is traded on average, about 15 times per day between banks. So we're talking about very short periods of time, a lot of trading in these going on between banks. And so basically, if you start to run down, you simply borrow from somebody else, maybe for a matter of a few hours. And then if you have excess, you may lend on a matter of sort of a few hours. And so there's lots of trading going on in here. And because this one is where banks settle between each other, so if customers at bank A owe money to bank B, it's in this actual market here that money actually moves. If this stops working, then basically most of the rest of the financial system will stop working at the same time. And we saw that in the financial crisis when we said it froze. Basically, banks stopped lending to each other, And if you remember back in the section on the Reserve Bank, we talked about the discount window. Under normal circumstances, the bank will not go to the central bank and borrow from the discount window. And we looked at a 2006 figure, which is pre-crisis, and the U.S. Federal Reserve was issuing about $60 million worth of loans through the discount window per week. In the financial crisis, when banks would not lend to each other, that went up to around, I think, somewhere around the $850 billion per week. So it was an increase in about a factor of 15,000. And what that tells you is basically the volume of trading that would normally go on between banks. So instead of trading with a central bank at the discount window, they trade amongst themselves. So when that stopped working, basically a lot of the rest of the financial system stopped working at the same time. So it's very critical that this thing work properly. So again, it's adjusted liquidity. The actual interest rate is known as the cash rate. For us, it's called the official cash rate. In the U.S., it's called the federal funds rate. You may have heard they just changed it yesterday or the day before. Federal funds rate, that's what they call their ones. And basically, it's for them to adjust their liquidity. And so, that diagram, bottom, temporary. We're talking often in terms of like a few hours. You get short, you borrow for a few hours. If you have surplus, temporary, again, you may only have surplus for a few hours, but you can lend it in this market and earn a little bit of interest. Okay, any questions on that before we move on to repurchase agreements? Okay. Well, we've met repurchase agreements before. Anyone remember what they are? What are they? Yeah, go ahead. Well, okay, you're reasonably close. The idea is that if you, instead of selling a security and just sold it and it's gone, in the repo, you actually make an agreement at the time that you sell it to repurchase it. So let's work out how this thing works. So let's take, here's two banks. Here we go, yeah, bank. A and B here. And so this one here, let's say they're low on liquidity. And they're going to cure their problem with a repo. So they will have some securities on their books. Typically, the repo market deals in very low risk securities. But let's say it has some government bills. So we have some government T-bills. And so what it'll do, there'll be a sale to Bank B, and they will now, they will own them. So the government T-bills are going over here, and the cash has come back this way. Now that looks just completely like any other sale. The thing that makes the repo different from other types of transaction is that at the time that you make the sale, you agree both the date and the price of the repurchase. So, this is, we'll call this day 0. Let's make this a 2-day repo. So at day 2, this thing will reverse itself. So the T-bills over here from this bank, which now had them, sells them back to A, and they pay a price, which is, this includes the interest. But the key thing about it is that this date and this price here, they are fixed at the time that the thing started. So at the very time you start this agreement, you actually fix the day, or if it's a short term, say it's 3-hour one, you fix the time and you fix the price at which you'll buy it back. So for these 2 days, this particular bank, which got low on liquidity, has got some extra money in. This bank over here obviously had a bit of excess and was able to invest it for 2 days, that money for those 2 days, and of course at the end they get some interest on that investment. So looking at that, thinking a second question, how does a repo agreement, a repurchase agreement, how is it like a secured loan? How is it like a secured loan? Yeah, go ahead.
So basically the person who sells security initially is borrowing, in this example, for funds, and then when they would repay the loan, they give the security back. So the security acts as the collateral for the loan. So if you don't repay the loan, the person you borrow money from is a security.
Okay, so yeah, exactly right. So this is like this money here. This is like the loan, and this stuff here, which is your T-bills, this is like your collateral. Now, the key point that you made there is if you got to this point here, say you got to day 2, and there was a default on the part of Bank A, they didn't have the money to pay it back. Would Bank B be in trouble at that point? If A got their money because they borrowed it in a repo, and now it's day 2, it's time to pay it back, and A defaults, doesn't pay it back. Is Bank B in trouble at this point? No. Were you shaking your head, or so? What's that?
Got a little bit of trouble. But on the other hand, we holding the security, so there's collateral. So it's kind of like even if Bank A got a default, but they still got something holding their hand.
Yeah. Okay, so in one sense, they got a minor problem, and is that they expected to get their liquidity back and they didn't get it. Okay, so that's a genuine problem. But they've actually got the assets themselves, and they are the legal owners of the Treasury securities there, the Treasury bills. And so because these are nice liquid markets, they can go and sell them. So the thing with these things is that, when you're thinking about low risk, the very fact that there is these securities being traded, and they're trading at fair market value here. We're not given any super discounts or anything. This is trading at fair market value. If there's a default on the part of Bank A, Bank B will probably have to sell these things on market, but it's not going to lose money over it. Okay, so it's fully secured, and in default, the other party there will not lose money because they should be able to sell these things in the market. Now, of course, if something like this happens in a real market, there tends to be a huge loss of trust all around because you don't expect this to happen. But at least in theory, because B is the legal owner of these bills, it can sell them and recover the funds that it needs. So I think we covered that. Let's see, look here. Again, here's these things about the sizes. These are just minimum sizes. Typically, you find that the actual trades are much, much bigger than this. $1 million for a day, 20 million is your minimum for a week, 50 million is your minimum for more than a week. But typically, you see that in these actual markets, the trades are much, much bigger than this. Tend to be very short term things. Now, one thing about this one is, point here, as the interest rate on the repo is lower than the interbank cash rate, because in the actual interbank market, in that market, the trading within that market is unsecured. Okay, and so when we're thinking about what interest rate should we charge, the risk that we take is important in factoring into it. So when you're thinking about trading in the interbank market, if you're just trading there unsecured, you're going to want a higher interest rate than if you undertake a repo, because the repo is safer because we have this security here, in this case it was the Treasury bill, that in the event of a default, we can go and sell that. So the interest rate in the repo market tends to be just a little bit lower than an interbank market, and that is because there is actually this lower risk. Again, agreed price eliminates the interest rate risk, because you know exactly what price you're going to get when it resales. Okay. Now, there's two types of them. If you take this one up here, there's a repo and then there's a reverse repo. Anyone know what the difference between those two are? What's the difference between a normal repo and a reverse repo?
Kind of like a purchase and sell.
Purchase and a sale rather than a sale and a purchase. Yeah. Okay, so whether a repo is considered to be an ordinary repo or a reverse repo depends on who initiates it. So in an ordinary repurchase agreement, you sell, and later you repurchase. And if it's the other way around, if it's initiated the other way around, you buy and then resell, that's simply considered to be a reverse repo. So looked at from one's perspective, there's always a repo and a reverse repo, and you ask, well, what is actually, the question is, who started it? And if it starts with a sale, then it's a straight repo. If it starts with a purchase initiated by the purchaser, then that's a reverse repo. So in this case, it was initiated by A, so that's an ordinary repo. If it was initiated by B, then it's actually a reverse repo. Okay, any question on this before we move on? Okay. So now we'll move to some of the actual securities that are traded in these markets. So the first one's up, the Australian Treasury note. These are short-term things. Most places in the world, most governments in the world do issue these short-term securities. So here's the characteristic of them. The first thing is that it's sold on a discount basis. All right, what's that mean? What does that mean when we say it's sold on a discount basis? Yep, go ahead.
It's sold for a price below its face value and receives the face value at maturity.
Yeah, so it's sold at a price less than the face value at maturity. It pays face value, and the difference between those two prices is the actual interest that you will earn. Maturity is up to 1 year. Minimum denominations, again, these are wholesale markets, $1 million with $1 million increments thereafter. They have a market there where in the secondary market, you can buy $5,000 parcels of these things in the secondary market. But even there, you don't often see private investors, and again, wholesale market, $1 million ups. And so one of the key things about them from a financial point of view is that they're considered to be default risk-free. So that means that you do not expect your local government to default. And that fact that we consider free of default risk is actually quite important in many financial calculations. In many financial calculations of many different types, you need what's called a risk-free rate to put into the calculation. And you ask, well, where do you get the risk-free rate from? Typically, this is the market where you go to look it up, in the Treasury bill market. The short term, typically somewhere around the 30 or 90-day market, is where you actually go to look for that risk-free rate. The liquid market, very, very low transaction costs there, highly liquid. And again, if you think about how much trading is going on in the U.S. market, $500 billion per day. Now that was back before this thing happened here, that figure of $500 billion per day. That was back in here, and they've had a 70% drop-off in the trading in that market. And so their liquidity problems there have gone up. And the fact that liquidity has dropped off in this market is actually quite concerning for a number of market participants. But back in the good old days, when you're having $500 billion traded per day in here, then the problems of either getting in or getting out of these securities basically doesn't exist. You can trade pretty much any number that you want at any time. The market is very active. And that's what we want for these types of markets. The fact that it's a little bit lower now, it's still probably around 150 billion per day in there. It's still a lot, but people think that at that level that there actually is starting to get low liquidity in there. That sounds a lot to me, but they are concerned that the liquidity is getting too low in this market. Okay. So in terms of when they were issued, there were none issued between this period here when they ran a budget surplus. And then they actually started issuing again when they went into deficit at the start of the financial crisis. And one of the things that happened as a result of this is that the financial market participants, they need these government rates, risk-free rates, pretty much for any time to maturity that they want. And also they need these government bonds and other government securities for building their yield curves. And they actually complained to the Australian government that not issuing these things was actually causing them problems because they couldn't get hold of the risk-free rate, and also they couldn't build their yield curves. And so even before they got to the point where they actually had to, because they got into deficit, they agreed at that point to start reissuing securities, even though they're running a surplus. And at that point, they agreed that they would issue enough securities to support a yield curve out to 15 years. Now, since that time, it's actually been stretched out to 30 years. But it's an interesting problem because, and the Australian government isn't the only one you see doing this, that governments that are running a surplus will continue to issue government securities even though they don't need the money to support the smooth functioning of the financial markets. In terms of what's on issue, there was, looked at up just earlier, about $4 billion on issue now. And so that provides a reasonable market for the thing. Now, when you see how these things are issued, the competitive auction is the typical way that goes on. So people just put in a bid. They specify how many they want in terms of dollars. They also specify what interest rate they want for these securities. And simply what happens is they line them up from the lowest interest rate up. And if, say, they're going to issue, say, 500 million at one time, they simply go from the lowest interest rate up till they hit the 500 million mark, and that's where they stop. So basically, they simply take whatever is cheapest. And the fact that it's a competitive market means that the interest rate that's set here is fair. And when you think about if you're going to use this in a calculation and you need that for a risk-free rate as part of your calculation, because it's done on a competitive basis, it means that that rate is probably as fair as you'll ever find. Anyway, if you want to price them, this is one of the few places in the financial markets where we use simple interest. Almost everywhere else in the financial markets, we use compound interest to both calculate returns and calculate value. But in the treasury market, the convention is to use a simple interest calculation. So this is it. This is your price here. That's your face value there. That's the yield. And that's the number of days to maturity. And in this part of the world, we use 365 days per year. In the U.S., they have a 360-day year of the year convention. So that makes a little bit different, but not much. So with us, it's pretty simple. Simply put in the real number of days per year, and you can calculate the price. So because there's no coupon, it's simply face value, work out the discount factor, calculate the price. And the difference between the price you pay and the face value, that's the amount of interest in dollars that you're going to earn over the life of the bond. Well, life of the T-note. Okay, any questions on that before we move on? Right. So, we'll do this problem here. Work this one out. Okay, so here's the deal. you're asked by your boss to buy T-notes maturing 115 days from a dealer. So going out dealer market, and you look up the dealer's bids and asks, and he's bidding at 1.07%, and he's asking 1.06%. So what we want to do is work out the price we'd pay per $100 and then how much we'd pay for 2.2 million of them. So how are we going to work out what we're going to pay per $100 face value from this information we have here? There's the formula. Okay, so we'll put formula up here. Price is equal to face value, 1 plus the yield, number of days to maturity, over 365. Okay, so that's our formula. Okay, so what's the face value that we're going to use? 100, yeah. And what yield are we going to use? You know, they always post a bid and an ask. The 1.07. Okay, 1.07. 1.06. Oops, I better have a vote here. How many people think 107 is the right one? Okay. How many think 106 is the right one? Okay, reasonably evenly split. Why do you think you should use the 106?
Because the ask price is the dealer willing to sell. The bid price is the investor willing to buy. So consider that when you sell the property, there's no point you pay higher than that.
Okay, so the ask, basically, if you think about it, because this thing has to be turned into a price, this is his price. I am asking for this much money. You know, that thing's got to be turned into a price. The other one is, you know, I'm putting a bid out there. I want to buy. So if these things look from the dealer's point of view, a bid is he is willing to buy, and ask, you know, he is willing to sell. And so in this case, we'd use the 1.06%. So that, once you convert that into decimal, is 1.06, 1.106. So, yeah, the fact you got two in there, they always give you two. You know, he's asking 1.06. And if you think about the inverse relationship between the yield and the price, the lower yield gives higher price. He will, you know, sell to you at a higher price than he will buy from you. So the N number of days, 115. So plug that in there. Price 100, 1 plus 0.0106 times 115 over 365. And where's my numbers? And so you're going to pay 99.6671 per $100 of face value. Okay? Any question on that before we work out how much it's going to pay for the 2.2 million? Okay. So to get the 2.2 million, if we turn this into a decimal percent, you know, for the 2.2 million, you know, $2.2 million, we'll just multiply it by 0.096671, and that comes out at $2,192,677.06. That's what you would pay to buy $2.2 million worth of face value. And of course, if you held them through to maturity, then the difference between the 2.2 million, which is the face value, and this one here, that difference between those two is the interest that you'd earn on it. Okay, so that's how you earn your interest. The difference between this price is what you pay for to buy them now, and that's what you would get if you held them all the way to maturity and it was paid out. So the difference between those, which is about, what's that? About 7,400 approximately. That would be the interest you would earn. Okay, any questions on that? Right, okay. Oh, yeah, we'll stop at this point, so if you want to ask a question, you can come and see me. Yeah, time's sort of run up. So if you want to ask any questions, be around for a while. Otherwise, we'll see you on Monday.
I'm just wondering, can you tell me the